In 2017, Magnolia Pictures released a documentary called China Hustle, a film which exposes a very long-running U.S. stock market fraud by Chinese companies.
It's a total fraud.
If this one company is so brazenly fraudulent,
We have to worry about all of them here in the United States.
This film highlighted one of the biggest blind spots in our stock market oversight. Most of the audits of Chinese companies listed in the U.S. are not open for U.S. inspection. With a new law enacted recently, however, the situation might be better, but more remains to be done. For decades, Chinese companies listed on the U.S. stock exchanges enjoy a regulatory privilege. They don't need to show their audits to American regulators for inspection, even though it is required by U.S. law and other companies comply with it. Why is this? According to the Public Company Accounting Oversight Board, Chinese laws governing the protection of state secrets and national security have been invoked to limit foreign access to China-based business books and audit records and audit work papers. In other words, American regulators cannot inspect the audit paperwork of, for example, the well-known fraudulent Luckin Coffee, because its China-based auditing firm cited China's state secrets and national security reason. This represents one of the biggest blind spots in U.S. stock market oversight. As of October 2, 2020, there were 217 Chinese companies listed on the U.S. stock exchanges with a total market capitalization of $2.2 trillion. Finally, this problem started to get corrected. In December of 2020, President Trump enacted into law the Holding Foreign Companies Accountable Act, after it passed both House and Senate unanimously. It aimed at banning trade of any securities of Chinese companies on U.S. exchanges if the U.S. regulators cannot inspect their audits for 3 consecutive years. Furthermore, the bill requires these issuers to establish that they are not owned and controlled by a foreign government. On March 24, 2021, the U.S. Securities and Exchange Commission announced that it was taking initial steps to enforce this law. Though it is a welcome step, more remains to be done. For example, it still gives Chinese companies a 3-year grace period to have their financial audits ready for inspection, including those soon-to-be listed Chinese companies which had continued to flock into the U.S. while Congress was passing the law. In 2020, a total of 32 China-based firms came into the U.S. for initial public offerings, the highest number of Chinese IPOs since 2000. In the first quarter alone of 2021, the number of Chinese IPOs already reached a whopping 16. Indeed, 3 years may be long enough for those who aim to use public listing as a quick way to do fundraising. For example, Luckin Coffee. Once hailed as China's homegrown rival to Starbucks, Luckin Coffee listed on the NASDAQ stock market in May of 2019. It revealed just 11 months later that more than 300 million of its 2019 sales were fabricated. Luckin's stock collapsed following this disclosure, which ultimately led to losses for investors, the delisting from NASDAQ, as well as a bankruptcy filing a few months later. Yet, before this saga, according to a report circulated by Muddy Water in January of 2020, Luckin's management has cashed out on 49% of their stock holdings, or 24% of total shares outstanding, through stock pledges. Carlson Block, founder of Muddy Water LLC, warned U.S. investors at an SEC roundtable on emerging markets. He said,
"So to me, the defining difference that I think investors really need to focus on is that many emerging markets lack what we think of as a rule of law."
And went on to say,
"Corruption. And I have noted that generally, whether you're talking about an organization like a company or an entire society, corruption can cascade down from the top. So if you have a corrupt leadership, much of the society will operate that way. And what that means is many of the people who come to control significant businesses, the kind that would list in the U.S., are beneficiaries and participants in that system."
Another reason for a Chinese IPO surge might be that they hope to grab a share of this last supper before the geopolitical risks get out of control. According to Christopher A. Lacavella, CEO of American Securities Association, as China's great power competition with America intensifies, financial markets have become a frontline battleground. The Chinese Communist Party has used deceptive statecraft to methodically exploit the U.S. capital markets. This has helped fund China's rise while exacting heavy costs on American investors, the U.S. economy, and the integrity of the U.S. capital markets. In a sense, this Holding Foreign Companies Accountable Act is a move in the right direction. But it remains to be seen if it is too little or too slow to correct the U.S. stock market's China problem, in an increasingly intensified backdrop of U.S.-China rivalry.